Hello, today we're on session number 3, which is on mod 5 in the book, which is revenue, receivables, and other expenses. The comic strip here says, I work for a lot of nonprofits, and some of them became nonprofits after I started working for them. Well, I hope that doesn't happen to you. So today we're going to jump into one of the most important GAAP principles, which relates to revenue recognition. Objectives, we have 6 of them. One is revenue recognition. The second is what is deferred revenue. The third is foreign currency and how it impacts revenues and the balance sheet. Fourth is accounts receivable and how we handle allowance for uncollectible receivables, namely bad debts. Objective 5 is operating expenses and the case where there is a discontinued operation. And then 6 is pro forma and other non-GAAP disclosures. Oh, you'll note that in the book there are 2 topics covered pretty extensively, but I find that they are not that common for our students to need to know. If you need to know them, then you can look it up, but it's not too common. The first is using the percentage of completion method, and the second is the allowance for sales returns. So they happen, of course, but they're not the main topics of the chapter, so I've chosen to not cover them on the video or in our workshop sessions. First, revenue recognition. The most common area of abuse and fraud is revenue recognition because it's very tempting. And the difference is you count $1 million sales or you don't. So that has big bearing on the revenues and net income for a company. So companies are often aggressive in the area of when do you count something as revenue? And for something as simple as Starbucks, it's easy. You buy a cup of coffee and they earn revenue. But for other businesses, particularly complicated commercial and industrial businesses, there may be many gradations of what is to be done by the seller of a product or provider of a service, and when is it really complete. So it's ambiguous. The first is when the good or the service is provided to the customer. In other words, the performance obligation is met. And again, Starbucks is easy. You got your barista to give you a cup of coffee. But I'll just give you one example when it's not so clear. Let's say you are the coder of custom computer software and you believe you've finished the task and you deliver the code to the customer. Now, the code is there. It worked on your machine, but does it work on their machine? Does it work in their network? Does it work when multiple people are hitting the database at the same time? And what about the training? Do you need to train them on how to use your software? So you see that merely delivering software may or may not be the end of the story. You may have other services to provide. Or there may be bugs that were not evident on your machine, but based on the computer environment or the networking environment, a bug may appear. So that's why different companies in the custom systems or software business may have very explicit policies on when do they consider the earnings process complete and this notion of a performance obligation actually completed. Second is whether or not the cash is received, you count it as revenue. So again, Starbucks is easy. When you get your coffee, you've already paid for it with cash or a credit card. But it's not so common in business. So in business, there are often accounts receivable from the standpoint of the seller, accounts payable from the standpoint of the buyer. The other consideration is, do you have to wait for cash to be received? The answer is no. Once you've earned the revenue and you can record it as revenue, that's fine. It is independent of whether you receive the cash. And so again, this is quite common in businesses where you buy a product or you obtain services on account or on credit. And the work is done, you just will pay them typically again. Normal commercial terms is 30 days. So the earning process occurs, revenue is recorded, and then after the fact, cash is actually provided from the buyer to the seller. Next, when is it met? So let's look at some specific facts that might help us distinguish on when that test is completed. First is legal title. Legal title is often in the shipping of goods from, let's say, one large supplier to a large buyer. And often you see this term called FOB, destination, or FOB, shipping point. And that FOB stands for free on board. And what that means is that's the point at which title passes. So if it's FOB shipping point, once the ship has been loaded with the goods from the seller, it's deemed to be the buyer's property. So at that point, title is transferred And so the process is complete. On the other hand, it might be FOB destination, which means the seller owns that piece of equipment or that shipment of goods. Say it's coming from China, so they put the container ship on in Shanghai. It makes a slow journey across the Pacific Ocean, and all the while it's owned by the Chinese supplier, and not until it reaches the destination does title pass to the buyer. So that's what we mean by legal title. Physical possession, when you actually physically send it to the customer, now your process is complete. Now there's that time in between. So if you ship via, say, UPS or FedEx, often companies say that once they hand that box to the FedEx or UPS driver, that the earnings process is complete from their side, and from then on, it's up to the common carrier or the trucking company to get it to the customer. So a very common recognition point is when you hand the box to the shipper. Third is when the risks and rewards are passed to the buyer. So this might look like a car or a signed lease. At that point, the risks have now shifted to the buyer, and that is an evidence that you are done with it as a seller. And finally, that the other party has accepted the good as being satisfactory. Back to that computer software idea. So there is a common term called a certificate of acceptance in software. And that means that the customer can receive the code but not sign it yet. Maybe is trained and not sign it yet. Maybe they work it for a while with multiple people and not sign it yet. And only after the bugs are cleared and everyone's happy will they sign this piece of paper. And that piece of paper tends to be pretty definitive that whatever was contracted for was delivered and the obligation is clear and the seller has done his or her work. What are complications? If I mention that this is such an area of fraud, why is it so complicated? Well, part of it is that ambiguity as to the point of recognition, but here are a couple of others. The first is multiple products served or bundled together. So an example here would be Microsoft, where they bundle some hardware and some software, and you pay one price. So how much of that cost is tied to the hardware? How much of that cost is tied to the software? Now it matters because the hardware is sold at the moment, so that revenue can be recognized. But what if the software has a 1-year license to it? So that portion can only be recognized over the 1 year. Second is non-refundable fees paid up front. So just because a customer gave you a deposit that's non-refundable, did you actually do the work? The answer is no. If you haven't done the work, then you have not met the performance obligation and it is not a sale. Third is bill and hold, where you bill the customer, they may even pay you, but you have not yet shipped it. So you're going to hold their money until you ship it. An example of this is Tesla. Tesla cars, when they first started, received many millions of dollars of deposits from very anxious buyers, and they got the money, they deposited the checks, and it was in their company, but they haven't earned it yet. They have yet to complete and deliver the car to the customer. So that is an example of bill and hold. The fourth example is consignment. Consignment is where I have an old piece of furniture and I give it to a consignment retailer, and they put it in their showroom, and customers walk in and they look at it. If they want to buy it, they buy it. And once it's sold by the consignment retailer, they split the money with me. So let's say it's worth $1,000 and they keep 20%. So it's sitting on their floor. And once a customer comes in and buys it for $1,000, at that point, the consignment seller will give me a check for $800 and they would keep $200 for their work in selling. That's consignment. So there's no sale until that ultimate transaction between the real customer and the consignment retailer. Licenses. Licenses is very similar to what we talked about earlier with Microsoft. If you have a license, it tends to be for a period of time. There are such things as perpetual licenses, which are forever. In those cases, a little more of an estimate on what is the reasonable life of that particular software. But many software these days have expirations. They have license term. Franchises. Franchisees pay franchisors a lot of money for a lot of things. So if you're a McDonald's corporation and you have a franchisee who operates in San Francisco, they will pay you a fee. Well, how much are they paying for and what is it compensation? So if they buy cups and paper and straws, that's clearly tied to the sale of a product. If it is for the right to do business for, say, 10 years as a franchise in control of a certain area in San Francisco, that is a cost that should be spread over the life of the franchise arrangement. And finally, there might be variable compensation where there is, I'll pay you $100, but if it goes really well and certain things occur, I'll pay you an extra $50. At that point, certainly the 100 is something you record, and the rest is based on probabilities, experience, and also your assessment. So to be conservative, you'd count nothing until you got the money. To be aggressive, you would estimate how much you expect to get from these contingent sales or contingent amounts and record that. But that's on the edge.